8 students are not in. So talk about sensitivity analysis. So say scenario analysis, sorry. Say scenario analysis, which is now number 3. Scenario analysis. Scenario analysis. Then you say that a simple sensitivity analysis assumes that variables are independent of each other. A simple sensitivity analysis assumes that variables are independent of each other. A simple sensitivity analysis assumes that variables are independent of each other. You see, now what we looked at in our previous class, we were assuming that you can be able to vary one item at a time, right? So that the rest remains constant, meaning that they are independent. You can change one without affecting the other. So that is what we are saying. Are independent. They don't depend. So a simple sensitivity analysis assumes that the variables are independent of each other, full stop. And I'm trying to explain that in our previous class, we were assuming that you can be able to vary one variable while maintaining the rest constant. A simple sensitivity analysis assumes that the variables are independent of each other. Full stop. Practically, this is quite impossible. Practically, this is quite impossible. Since most variables are interrelated. Practically, this is impossible. Practically, this is quite impossible since most variables are interrelated such that a change in one variable may lead to a change in another variable. Might lead to a change in another variable. Practically, a change in one variable might lead. Practically, this is quite impossible since most variables are interrelated, such that a change in one variable may lead to a change in another variable, full stop. Scenario analysis therefore considers all variables changing simultaneously. Scenario analysis therefore considers all variables changing simultaneously to give a particular scenario to managers. Scenario analysis therefore considers all variables changing simultaneously to give a particular scenario to managers. Yeah, they are changing simultaneously to give a particular scenario to managers. The scenarios are number one, the worst case scenario. The scenarios are Then we have number 2, base case scenario. Base case scenario. Then we have number 3, best case scenario. So when you want to do business, sometimes you always say that if things go well, then I can make this profit, right? Or if things go well, then maybe the cost can actually go down. That is the best case scenario. Then the normal scenario is called the base scenario, the normal scenario. The worst scenario is when things turn contrary to your expectation. So when you're investing and you're expecting next year or the following year's income, you expect profits to be higher, then that means that basically it is the good scenario, the best case scenario. So Florence, we have not gone far. Actually, you are starting with us. The first statement was a simple sensitivity analysis. That is the first statement that we had. Nothing you missed. You are actually on time. Sasawa. So don't worry. The first sentence that you've written is the one that we have also written. And you are on time. Now, we are saying that in scenario analysis, we are looking at conditions. You can plan to do business, but then things don't turn out as you expected. And in scenario analysis, we are saying that it is possible that all the variables change. In the previous example, we were looking at variables changing one at a time when the others remain constant. In this one, we are assuming that all of them can change at the same time. But then what we are asking ourselves, what if it happens? How will your business look like? So that is why we are looking at scenarios. We can have boom. We can have, how do you call the other one? When the business is not doing well. The opposite of boom is, okay, so we are having those two scenarios, the three scenarios. This one can also be called pessimistic, and then we have optimistic scenario, pessimistic and optimistic scenario. We always have boom and recession, right? Okay, that's true. Now, let's look at an example that things can change. So having an illustration and say, we are going to do 2 illustrations. So better you give me answers very fast. We shall do this, and then we shall do another one, which is the year 2022 December. So look at the paper 2022 December. We shall look at question number 1, B. 2022 December, question number 1B. That is a case of scenario analysis, though it has some elements of sensitivity analysis. It is an advanced sensitivity analysis, which is called scenario analysis. We shall be able to look at it. Now, look at this illustration. So have an illustration, and you say, illustration. And then you say, the cost of project is 4 million. Assume that you're given the following information. Cost of project is 2 million, is 4 million. The cost of project is 4 million. Cost of project is 4 million. Cost of project is 4 million. The life of a project, life is 5 years. What basically we are doing, for those who are joining today, Nelson, is that this subtopic called scenario analysis. Scenario analysis is part of capital budgeting. And when you're doing capital budgeting, you always think about the profit that you can get at the end. And so in capital budgeting, we have so many subtopics. There are almost 10. So the first one was called simulation. The second one, sensitivity. We are doing the third subtopic. So ideally, this one should be our fourth or fifth lesson. Mr. Moses here will be able to share with you a few videos that you could have missed. So we are looking at a situation where you want to budget, and as a finance manager, you will think about a project that can give you some good revenue in the future. So we are giving you a case study where you are starting a project, and the initial cost of starting that project or the cost of buying a machine is called IO, and that is the 4 million. So Pesa is asking, which question is this? It is the one that I'm giving you now. That question is what I'm giving you now. Assume that you're given a project where the initial cost of buying or starting the project is 4 million. The project is 4 million, right? The life period for this project, it could be a machine that you want to use to produce some items which can be sold. So that machine can cost you 4 million. And we are saying that the machine can last for 5 years. That means that during the lifespan of the machine, you will be generating some income from that machine. So we are giving you a case study in a summarized form. The examiner will give you a whole statement, but you can condense them so that you have them in a summarized form with points only. So we have the cost, which is 4 million. 4 million. Then we have lifespan 5 million, 5 years. The depreciation is given a straight line. Depreciation is given a straight line. Just 1 minute. 1 minute. I'm seeing a call here for that meeting that we're supposed to attend. Sorry for that. That meeting will take only like 5 minutes. In fact, less than 5 minutes. It is a WhatsApp call. It will take some few minutes. So for those who are joining, I've said that you assume that you're given the following cost of project is 4 million. The lifespan is 5 years, depreciation straight line, tax 30%, and the cost of capital is 12%. Then you're given the following conditions. We have possible outcome. Possible outcome. The possible outcome. Then we have the variables. So possible outcome. Then we have the variables. So we have the worst case scenario. That can be the outcome. The outcome can be worst. We have this, and then we have best. That is a possible scenario. That is a very possible scenario. Now, we are looking at a situation where, in the best case scenario, the units that can be produced and sold annually is given. So we have units produced and sold annually. Produced and sold annually. That is, in the worst case scenario, we have 11,000. Then we have 12,000. Then we have 13,500, I believe. 13,500. Those are units that, if things go well, you can be able to produce using that machine that you bought and sell them fully. Nothing will be left unsold. So that means that they are basically giving you the quantity produced that you can use to now calculate and get your revenue. Are we seeing? The examiner is giving you revenue indirectly. It is telling you these are the quantity that when you produce and sold, you can get your revenue. It is also saying that unit selling price is given. The unit selling price is given. That is a very good examiner. Unit selling price in Kenya shillings. is given. So we have, in the worst case scenario, it is 750. In the base, the normal scenario called base is 780, and then we have 800. That is the best case. Of course, in the best case, we expect a good sale and a good price, right? So it makes sense. Let me tell you, in exam, the question must make sense for you to be able to solve it. So you have to appreciate what the examiner is setting, all right? So in normal scenario, the normal scenario is 780. When things are not very good, you can sell at 780, but if things are good, you sell at 800. You can see the production as well. Annual fixed cost is given. So we have annual fixed cost. So annual fixed cost is given as 100,000, 120, and 150. 100, 120, and then 150. So can somebody calculate for me the sales? Sales for all the scenarios. Start for me solution here. Have the scenarios worst, best, and best. Then tell me the sales, total sales for each scenario. I'm getting into that small meeting. I'll be back. So I want you to try here and get me the profit that can be made. You have the fixed cost, you have the sales, and like site-like information. I'm getting back shortly. Shortly after maybe 3 minutes. Then we proceed. Are we okay up to there? We have seen how to get our sales, which you have calculated. It is the unit price times the quantity. We say that the variable cost is 15% because the examiner said that contribution margin is 85%. So that means that the variable cost is 12% of the sales, and we are able to get that. Then we come with the fixed cost. Whatever we're going to get here is now our gross profit, isn't it? So confirm to me that that is okay. We are okay, not only Ruth and Edwin. Florence, where are we? Are we having some challenges? So somebody was telling me that this one is the net profit. Sawa. Mimi sasa nasema this is profit before depreciation and tax. Profit before depreciation and tax, which we can get. Get me the profit before depreciation and tax. Then we say less depreciation first, then less tax. So less depreciation and get me the value for depreciation. We say it is a straight line. There is no salvage value. Straight line, there is no salvage value. And the item is just 4 million. Get me depreciation and profit before depreciation and tax. So somebody has given me the figure here. 69,125,00. 69,125,00. Then we have 7944. Confirm those figures. Confirm the figures. So the next one is 70. Mimi nasema I'll confirm the figure. Somebody was giving me a wrong figure, 79. So it should be 78, 56. 78, 56. 78. Most 78, 56,000. And then we have the next one we have, this is 78, 36 or 56? 78, 36, eh? Sawa. 78, 36,000. And then we have the last one, 9,080,000. Is it 80 or 30 bana? Kwani kufanya hesabu ni ngumu? Who is saying the truth? 9, 90, 30, 90, 80. Can we just avoid those small mistakes that can make us lose? Should be 90, 90, 30. By the way, let me just repeat, and I'm warning you guys. Those errors are serious. Don't just see them that they are errors. There are errors that you can ignore. Kama is a decimal, rounding off, those ones are okay. But the ones that relates to adding, I'm assuring you, when you miss it here, the whole thing is damaged. Hata kama wewe unafikiria umefanya mtihani vizuri aje, utarudi. You cannot add this correctly. I'm telling you, that is a serious problem. So make it, just try to be accurate. Usiwe na haraka. Just do it right. It is 90. Oh, you see now. So that means that I have to assist you guys. Calculate this figure. Let me take my calculator. So my calculator can help. I have here 10, 80, minus 1620 minus 150. I'm getting 9030. So how are you guys getting 9080? 9030. Okay, so get me the precision charge. Then we proceed. Proceed from there. So we have 800,000, right? For that one does not change, it is the same, right? So we have that throughout. Yeah. Now the next step, you guys know this. After we got this, our main aim is to get the free cash flow. What is the next step? Now get me the figure here, the balances, and then the profit before tax. So we call it profit before tax. Get me the profit before tax. Our main aim is to finally get our profit after tax, net profit. So get me the profit before tax. So those who are joining today, when you're looking for free cash flow, you get the normal way of getting income statement or doing or performing income statement, calculate the income statement. But make sure that after tax, you add back the depreciation, because depreciation is not a real money that left your account. We are looking at cash flow. And that is why when you are preparing cash flow, what do you normally do? You start by net profit, then you add back cash flow. Because cash, you add back depreciation. That is how you do it in a FARS. You have net profit, reported profit, then add back depreciation. Then you can now look at the changes in receivables and those other things. Because depreciation is not actual money that left your account, but it was removed for the purpose of taxation. The amount for tax was actually removed, so you add it back. But here, first you need to get the amount that you're going to tax, and somebody is telling me that it is 611.25, so 61, 1, 25, 61, 1, 25. Right. And then the next one, 70, 30. You have not corrected MA. It is my calculator. Oh, AMA, it is my calculator. Oh, what is the problem? Should be 90, 80. Wewe. Not quitting, amesema haizi quit. Sasa not quitting hii ni 15, which is 150. It is not your calculator, it is your eyes. Hiyo ni 150. That is where you're messing it up. Otherwise uko sawa. So it is not your calculator. Sawa. Umesema hapana quitting. Yes. Hapo ndio kuna shida. Now, let's proceed now. So this other one is 70, 36 ndio. So we have 70, 36. And then we have the next one is 82, 30. Ndio. 82, 30. 82, 30. Okay. So that is fine. Now, we now tax. Let's tax. Let's tax 30% at 30%. Remember what I said, that if tax is given, then depreciation is now relevant. It is good to depreciate. Ukiona tu umepewa tax rate, then know that you're going to depreciate it, because depreciation is very important. Just ask yourself, what are the number of years lifespan? Then you now depreciate it. Depreciation only becomes relevant when there is tax, because it will enable us to tax, to know amount to tax, and then we just add it back. If you are not taxing, we are not going to add it back. Don't even care about it. Depreciation is irrelevant when we don't have tax. But when we have tax, it is very, very relevant. So get me the 30% of this. You're getting 183, 750, 183, 750. And then the other one is 211, 0800, 211, 0800. And then we have the last one is 2469. 2469,000. 2469,000. Okay, so let's now add and have our profit after tax, PAT. What is your profit after tax? The first year, you're getting 42,78,750. 42,78,750. You'll confirm. You guys will confirm. 49,25,200. 49,25,200. Then the last one we have 57,61,000. 57,61,000. Can you guys now add back depreciation? Add back depreciation. When you add back depreciation, what you get? So what you're having there is like this. Our profit after tax, hapo chini, is something that looks like this. Profit after tax is 42,78,750. Then we have 49,29,25,200. Then we have 57,61. Then now, after that, you now add back depreciation. So you say add back depreciation. Which was 800,000 throughout. 800,000 throughout. So your free cash flow, is now the sum of this free cash flow. Now, just before we move, sometimes the examiner can tell you that the company has agreed to save some money every year that they can use to replace the machine. So on this cash flow, you need to remove the amount that they are saving to replace the machine. Yani wanaweka pesa ingine kando, ati machine ikizeeka watakuja ku replace nayo. Because they didn't put depreciation a kando, but now they're just saving some money every year. Now, when you're just about to get the so-called free cash flow, which is this, you now come and less replacement cost. Sawa sawa. Kwa sababu hiyo pesa iko committed. Hiyo pesa wanatoa hapo, wana save. So get me the free cash flow. Now that we don't have replacement, is fine. If you had replacement, you remove it from here, then that is when you now have a free cash flow. It means that this cash flow that does not have any commitment. So in this case, they have not told us that there is any replacement cost that they are saving. So tell me what you're getting. The first one is 7, 5. This one looks like 50,78,750. 50,78,750. And then we have this one, looks like 57,25,200. And then this one looks like 6,561,000. Kindly confirm if those are the figures. You add back depreciation, then ndio unatoa replacement cost, alafu unapata free cash flow. Yes, yes. If they told you that there is money they normally save to replace the machine in future, waende wanunue ingine, sasa hiyo pesa iko committed, kwa hivyo unatoa. Sawa sawa. Is a replacement cost. The examiner can tell you like that. So when you get it in exam, don't say that, how comes this one I was not told. Now we have our free cash flow. This free cash flow we normally multiply with the discounting factor to call it present value. So when you multiply free cash flow with a discounting factor, you call it present value. So you can now have our free cash flow here. Then you now have discounting factor, which is PV. Why? Is it PV or PV? Because if we take worst case scenario, then you are assuming that for the next 5 years, it is a worst case scenario throughout. If it is best case scenario, the period for the machine is 5 years. Every year it will be best for the next 5 years. If it is best, so don't consider these cash flows as irregular. Why? Because they are not changing. We are not saying that they keep on changing every year. We are saying that there is a possibility you can buy a machine na maneno ikuwe mbaya throughout. Kama hii government ya Jubilee ni worst case scenario throughout. Sindio? You don't expect that it's going to change anytime. So that one we can have here. So therefore we use PVFA. Yes. So we have PVFA. Every year itakuwa hivi for the next 5 years. PVFA. And you know the formula, 1 minus 1 into 1 plus R negative N all over yote all over R. That one is okay. So get me the discounting factor for the worst case, the best case. In fact, they are just the same, right? What is the discounting factor? Because that does not change with the scenario. It remains the same. So what is the discounting factor? Discounting factor is .6. This 3.6048. So that should apply to all of them because the period is the same. Now, can somebody get us NPV? Calculate for me now NPV. Then you perform the risk assessment, which is called the sensitivity analysis. You perform the NPV, calculate NPV, and do sensitivity analysis nione. Sasa, sensitivity analysis, I want 183.
So, I called us here so
that we get me the NPV. Get me the NPV. No, we are done. I'm just waiting for you guys to give me the NPV. After getting the NPV, you calculate the assessment, and that is it. The way we did, new minus old all over old, that is it. New minus old all over old, NPV. So kindly do that and share with me. I'm just starting the meeting, and luckily we are done with the class. So go and do that and take a break. Sasa, you calculate the NPV. This PV, you'll get the PV. Minus IO, you'll get NPV for both of them. This base is going to be the old, and then this is new, this is new. So you'll perform base as the old, this one you use as new, and also do this for new. So you'll be having two news and one base. Base is the old. Sawa. So do that and share with me. I'm getting to meeting shortly. Sawa. So that was what we're supposed to cover today. And then now the assignment that I'm going to share on WhatsApp, we are going to try it together with you guys. The one for 2022 December. Yes, we can leave the meeting. That was what we needed to cover today.